And I'm very excited to welcome Peter Leighton. He's the co-founder and chief operating officer of RE Royalties. So Peter, please come on, turn on your camera. Great to see you. Peter is an innovative, RE Royalties, I should say, is an innovative financing company that's helping to create a cleaner future by investing globally in renewable and sustainable energy. Peter has been involved in the clean energy sector for over 25 years and has brought over $1 billion worth of clean energy projects from the embryonic stage of development all the way to the build stage. Peter holds a Master in Business Administration from the Sauder School of Business and was named as an honoree of Canada's Clean 50 for 2020. Peter, it's a real privilege to have you here and share the journey with us.
Thank you, Jose. I really appreciate the introduction. I'm just going to share my screen here, so hopefully everyone will be able to see the presentation. So good afternoon, everyone. Normally, as the last presenter at a conference, I would be watching everyone bundling up to catch an early flight. So the good news is I can't see you doing that now, and I really do thank you for taking the time today to attend my presentation. My name is Peter Leighton, and I am the COO and co-founder of RE Royalties. RE Royalties is the first royalty company focused entirely on the renewable and sustainable energy sector. And I'm here to tell you today about RE and how we are helping to finance the green economy. Before I start on that though, Jose was reminding me of one kind of funny story. Someone asked me, why did we name it RE Royalties? And the funny thing is that we applied to the corporation's registrar in Canada under the name of Renewable Energy Royalties, and they came back to us and told us that wasn't descriptive enough, but they did let us go with RE Royalties. On the second slide here, I'd like to point out via this incredibly small print that this presentation will contain some forward-looking statements, and we are a publicly traded company, so please refer to our SEDAR filings for more information. Fundamental vision and objective of our company is simple. We want to build a cleaner and more sustainable world, and we want to generate a strong economic long-term return for our investors while doing it. How we set out to accomplish this objective is by acquiring a portfolio of long-term, stable, and diversified royalty streams from operating and near-term operating renewable energy projects that will provide our investors with resilient, sustainable, long-term growing cash flows. We operate based on four fundamental pillars. We want yield, growth, we want to make an environmental impact, and we want to ensure that we protect the capital of our shareholders. We are the first royalty company entirely focused on the renewable energy sector. Royalty financing is not always well known, but it is omnipresent in our daily lives. A lot of times we don't see it. To give you an example, before this presentation, there were probably 4 or 5 touch points in my morning routine which had a component of royalty financing involved. For instance, as a true Canadian, when I stopped by Tim Hortons this morning to pick up a cup of coffee, 3G Capital out of Brazil was paid a royalty on the coffee sale made by the Tim Hortons franchise owner. When I took my daily vitamins this morning, a pharmaceutical royalty company was paid a royalty on each pill I consumed. When I used my iPhone to check email, Qualcomm received a royalty on the chips that Apple used. And when I opened Spotify to listen to music to relax before the stress of this presentation, a music label or musician was paid a royalty. And when I ordered lunch on Uber Eats, Uber received a royalty, even though they did not make my lunch, nor did they deliver it. So you can see that royalties are pervasive in most of our modern daily lives, except for the renewable sector. We started out in 2016 with a small team of executives from both the mining and renewables industry. We recognized the opportunity to apply a well-proven royalty business model to the renewable sector, where royalty financing did not exist. We saw similar parallels to the exponential growth of royalty financing in the mining and oil and gas sectors in the mid-2000s, which has established the mining royalty giants of today, like Franco-Nevada and Wheaton Precious Metals. In 2018, we took the company public through an RTO listing on the TSX Venture Exchange. To date, we have invested $24 million into a number of transactions, and our compounded revenue growth rate has been 141% per annum. We have been able to achieve this growth due to two main factors. One, the explosive growth of the renewable energy industry over the past 5 years, and two, the exceptional value our royalty financing model has been able to provide to our clients. This has created a very strong demand for our product with, I must say, minimal advertising on our part. Being first to market means that we're able to cherry pick the premium deal flow that fits our investment mandate and to establish a leadership position in the sector. We currently have 86 royalties from solar, wind, and hydro projects located in Canada, the United States, and the European Union. These projects generate significant amounts of clean energy per year, which is equivalent to powering approximately 116,000 homes and removing 360,000 tons of greenhouse gas emissions on an annual basis. As you're aware, the markets have undergone tremendous disruption due to COVID-19. While we hope the world will recover quickly from this global pandemic, our clients and our financial results have had minimal impact from this. In many jurisdictions, energy generation continues to be an essential service. Attached is a brief bio of our team. I won't drain this in its entirety, but my partner and co-founder, Bernard Tan, is a long-term financial executive who, prior to starting RE, was a CFO of a resource-based private equity group, where he was involved in several royalty-based financings as a client. And in fact, in one case, a royalty financing helped him take a publicly traded company, not only keep it alive, but then sell the company very shortly after the royalty financing was put in place for a significant premium for shareholders. Lukman Khan is a CPA and also our CFO. He was previously with Ernst & Young and is experienced serving as a CFO for a number of publicly listed companies. Bryce is our VP Investments and a CFA charter holder. He holds a Responsible Investment Certificate from the Responsible Investment Association of Canada. And Talia is our VP Communications and is a master's from the University of London and is a recipient of the BC Export Awards for International Business. The real message from this slide is that this is our entire team. We have a very small team, which allows us to be nimble while keeping our costs low. Currently, we trade on the Venture Exchange under the symbol RE. We have approximately 32.5 million common shares outstanding with a market capitalization of approximately 35 million. Our share price ranges in the $1 to $1.10 range with a 52-week range of between 70 cents and $1.45. We also currently pay an annualized dividend of $4 cents per share, so approximately a 4% yield. Our shareholder base consists mostly of family offices and accredited and retail investors. To date, we don't have any institutional shareholders. Management, board, and insiders currently own about 35% of the outstanding shares. As you can see, our balance sheet is also quite healthy, with very little debt on the books and a very strong working capital position. In the first quarter of 2020, we actually realized our best quarter in terms of revenue growth, despite the global lockdown due to the impacts of COVID-19. What this has shown is that our strategy continues to pay off in generating that stable, cash flowing return, and it's been very resilient despite the complex market challenges. To paraphrase one of our shareholders, as long as the sun shines, the wind blows, or the water flows, we will continue to make money. You can get more details of our published financials and MD&A, which is available on our website or on SEDAR. The key message to this slide is that the global market for renewables is massive. At more than $200 billion, more money was invested in renewables than either mining or oil and gas in 2018. The jump from 26% of world production to almost 45% expected by 2030 indicates that renewables are not a passing fad, nor are they a science experiment. It's here to stay. The chart below is a complex one that shows a traditional global electricity production mix being heavily weighted to coal and natural gas, but this mix is changing dramatically and very quickly. And the real driver in this, as shown on this slide, is that the cost of renewable generation is declining rapidly. Solar, for example, is on an asymptotic decline curve, with installed costs dropping from $3 million per megawatt 10 years ago to less than $800,000 per megawatt today. Wind generation costs have also declined by an order of magnitude in the last 10 years. And both solar and wind are an order of magnitude more efficient over the same time frame. Now, I'd be the first to admit that there's a fair bit of published political misinformation that likes to note how expensive renewables are. Lots of politicians seem to want to point that out. But the fact is that solar and wind are the cheapest sources of new electricity in more than 2/3 of the world right now, and will be the cheapest everywhere by 2030. For us, it's interesting that the fastest growing market for renewables in Canada is Alberta, the home of the Canadian oil and gas industry. And in the US, it's Texas, also, as you know, a major player in oil and gas. Currently, there are $80 billion in projects in ERCOT, that's the self-contained distribution grid in Texas. $80 billion worth of projects on the books to be built, and 75% of those projects, approximately, are solar projects. So it's a big market and it's growing. How do we take advantage of this? As I discussed earlier, the royalty business model is well utilized and well proven in many businesses and many industries, except for renewables. So we're a first mover looking for three things. One, renewable or sustainable energy projects. Two, we look for proven technology. We have a bias for operating projects or those that will reach operations in the very near term. We like near-term cash flow. And three, geographical distribution or diversification, because electricity does not trade as a global commodity. Markets are very regional. There are 12 in Canada and over 150 in the US alone. So we want to diversify our risk across multiple jurisdictions. We're currently active in BC, British Columbia, Ontario, Nova Scotia, Texas, and Eastern Europe, but we continue to look at opportunities in Australia, Japan, and Central Europe. For the time being, we are focusing on OECD jurisdictions. Our targeted returns are generally in the teens, which allow us to support a strong yield to our shareholders. We feel that for investors, we're delivering on the trifecta, growth and yield, while helping the planet. We essentially have two products. One, we acquire long-term 20-year gross revenue royalties, or two, we lend on a short-term basis, 6 months to 3 years, and acquire a long-term royalty. This is our favorite product because it allows us to recycle our capital. As you can see from the graph I guess it's a chart on the right, based on a 3-year term of a loan, we can lend the same capital 7 times in 20 years and generate 7 different royalty streams. Again, as one of our investors says, it's the power of 72. So those of you who are forgetting or don't have young children in math, power of 72 is the power of compounding. What it means is that same money that we lend 7 times in 20 years and create 7 different royalty streams, it makes our return on capital employed off the charts compared to someone who invests a certain amount of money just into one project. So we're really able to continue to deliver that growth. The idea is to allow our clients to recycle their capital and allow them to build more projects. And as a former developer, one of the most enjoyable things about the job for me is providing financing that allows that developer to hit their dream, because every developer wants to build a new project and it can sometimes be very challenging. So it is really a lot of fun to enable that. Currently, about 80% of our portfolio utilizes the loan and royalty structure. We like it because the loans are secured and collateralized against our clients' operating assets. The royalties acquired are long-term, 15 to 20 years. They're calculated off of gross revenues, and they're underpinned by long-term offtake agreements for the end product of the operator. The loans are repaid by our clients in a short-term horizon, allowing us to recycle our capital and acquire new royalties. I'll give you an example of one project that we announced, I guess we closed about 4 weeks ago, and in the press release, all this information is available. It was an Ontario-based operator And we basically put in place a short-term loan for them, a one-year loan that enabled them to complete some of their pre-construction projects. And we took a 20-year royalty on the full portfolio of their projects. They had 57 operating projects and 3 that were under construction. In terms of the mix of interest revenue that we get, we'll earn about $500,000 for a one-year short-term loan to that group. And then we will earn $100,000 a year in royalty payments for the next 18 years. So it really is a nice combination of we get our return on our capital while it's being deployed, we get our capital back, and then we continue to get that royalty out for till the end of time. This slide highlights the advantage of investing in a royalty company like RE Royalties versus investing directly in either a renewable energy project developer or operator. I won't drain this slide in its entirety, but the 5 key takeaways are as follows. 1, royalties are based on gross revenue, sheltering our cash flows from unpredictable factors like rising taxes or increasing operating cost environments. 2, compared to a renewable operator, developer, or supplier, we can maintain very low overheads. We don't need a huge pile of people. 3, we don't need significant construction or sustaining capital to get an asset operational and generate cash flow for our shareholders. 4, we can achieve cash flow diversification much more quickly. We spread our investments over multiple projects. And 5, we're in the nice position of being a first mover in a large and fast-growing renewable energy industry. This page highlights the investments we've made to date. To date, we've accumulated 86 royalties. Of these 86 royalties, 82 royalties or 82 projects are already operating, which means that the projects are cash flowing and servicing the royalties, and we don't have to wait for them to be built. Most of our investments are in either wind or solar, with a very small portion in run-of-river hydro. Our projects are located in Canada, the US, and the EU, jurisdictions with well-defined and regulated electricity markets. And you can also see on this list who operates the plants and purchases the electricity, which are primarily investment-grade entities like Crown Utilities. Finally, you can see the impact these projects generate. Several of our investments are in high carbon electricity areas like Nova Scotia, which is 95% coal generated, or Texas, which also has significant coal and other fossil fuel generation facilities. And so these projects can make a significant impact in reducing the GHGs that go into the atmosphere. Our plans for 2020 is to continue to grow our existing portfolio and complete accretive investments. So far in 2020, we've acquired 22 royalties from different portfolios of operational wind and solar projects. We continue to see incredible demand from our existing and prospective clients for royalty finance, and we expect to continue expanding the diversity and growing the size of our portfolio. I would say one of the surprising things that we have found is, one, the repeat business, so existing clients come back to us. Our very first client, we purchased a royalty off an operating project. He had a 1% interest in that project. He took that money that we provided, and he reinvested in a new development project where he was able to climb up to a 25% working interest. We're now in discussions with him about taking a royalty on that project, and that money that we would provide on that project would enable the same client to begin development of his third project, where he will be able to climb up to a 50% working interest. So it's a great outcome for us. We get a repeat client, and it's a great outcome for the client in that he is gradually climbing the curve of ownership of projects by getting more and more ownership in each project, and we're providing the funding to do that. So it's a great outcome. And the other thing that I think we have found that has been surprising is, again, without advertising, many of our client referrals come from service providers. So the very first transaction we worked on, the lawyer on the opposite side of the fence brought to us a client who needed similar financing. The third transaction, another lawyer brought another client. We've had accountants bring clients. We also find that fundraising drives an awful lot of business. Every time we go out looking for capital, we talk about our business, it turns out that many of the capital providers have clients who are looking for financing that we provide. So it's been a joy that way. In order to accelerate our growth, we've been exploring several options to secure non-dilutive capital so that we can foster more and more lending. Our options going forward are to, one, look at an issuance of green bonds, which provide a fixed income vehicle for investors, but would allow us to lever the returns and cash flows to our existing shareholders. The demand for green bonds has been extremely robust so far, especially from investors that are looking to make a strong, socially responsible and environmental impact while also making a good return. To give you an example, CoPower, which is an early pioneer of green bonds in Canada and now a subsidiary of Vancity Bank, announced a new $20 million issuance of 5-year green bonds at the beginning of March. By early April, they announced that they were entirely sold out. And another option we're looking at is the implementation of a co-investment fund. This would allow larger institutional investors to utilize our royalty investment platform, while our shareholders receive a return through management and performance fee, a royalty sharing arrangement. This kind of co-investment model is a way for us to bring a large-scale institutional investor into our capital structure without them having to become a significant shareholder. It's one of the challenges of having a market cap in that sort of $35 million range, is that if someone wants to invest $10 million into our company, they become a significant shareholder. If they want to invest $100 million in our company, then they own the company essentially. So the co-investment vehicle is a way to access much larger amounts of capital without having to get involved in the ownership issue. So I do thank you today for your time. In summary, RE Royalties is a unique and high-value investment opportunity because we're deploying a very successful royalty financing model into a large and rapidly growing renewable industry. We create value for our investors by, one, growing our portfolio through a reinvestment of capital to create new royalties. Two, providing long-term recurring cash flows from the royalties we acquire. Three, providing a strong risk-adjusted return by investing in lower risk operational projects while securing higher development style returns. Four, by being a first mover, we have the luxury of selecting attractive deals. Five, the cash flows from our royalties are resilient, predictable, and sustainable. And six, we focus on capital preservation by employing a combination of protection strategies such as senior secured loans, over-collateralization, and guarantees. Seven, we diversify our portfolio to mitigate any single project or any single jurisdiction risk. Eight, we have the right team to make this all happen. So I thank you all for attending our presentation, and I will now pass it back to Jose and open it up for questions.
Peter, terrific. Thank you for sharing that and the insights on a fascinating area of renewables, renewable energy financing. So we had questions that have come in during the call. The first one, and I think you talked about this already, but if you can reframe for us, what was the key criteria for the projects that you're looking at investing in this space?
So yeah, the key criteria for us is to look at, and we have a bias for operating projects. We don't have an interest in long-term tying up our money and not seeing cash flow. So we're very biased towards immediate cash flow. So we love operating projects. We are focused on renewable projects. So that includes solar generation, wind generation, run-of-river. We are looking at biomass and other types of renewable energy generation, but we are not able to invest in projects that involve the use of fossil fuels at the moment.
Very well. And I think you mentioned that you're focused on North America and Europe, is that right?
To date, we have been focused in North America, or we have royalties in North America and Europe. We are looking as well at Australia, Japan, other OECD countries. We're definitely the most interesting jurisdictions for us are ones that have a large current carbon footprint of their generation, because that's where we see the most opportunity for renewables.
Very well, very well. Another question has to do with the state of wind, solar, and batteries. And you talk about in one of your panels, you had the dramatic decrease in costs on those technologies. And the question is on what other trends or technologies or business models you're observing in the marketplace that may impact the viability of renewable energy projects.
Yeah, so we're definitely excited about storage. It is a game of incredible technical advancement, and we didn't draw the graph for storage costs, but they are also coming down on an asymptotic basis. But I think there is still there's a lot of time to figure out who has the best mousetrap, and we're following it very, very closely and checking the applicability is intense, but we have not yet engaged in a storage project because we're not 100% sure who's got the best solution. The other two massive trends that we see are, one is distributed generation and distributed storage. So folks who are interested in perhaps going off grid, or communities that are looking to be self-sufficient. So we're seeing tremendous push in that area, and we're following that. And the other area is the concept of corporate power purchase agreements. So if you watch any of the advertising, Budweiser now advertises that they're 80% fueled by renewables. I think Amazon claims they're 100% fueled by renewables. And so in markets like Texas or Alberta, where it is a deregulated market and where an end customer can buy directly from a generation project, we're seeing tremendous growth in behind the fence projects where it's the end user of electricity who is buying the electrons from the generator, as opposed to a state-owned utility or monopoly.
Another question that came, thank you for that, very helpful. Another question that came up here is that what does the regulatory landscape is looking like right now, and specifically in terms of government support or hindrance on investments when it comes to investing in renewables? What are you seeing in the marketplace from a regulatory standpoint?
Well, I think we are seeing a move away from the subsidization of the direct subsidization. So there is still some tax incentive within the United States market, but we're definitely seeing that renewables can now, on a non-subsidized basis, they are at grid parity, meaning it is now cheaper in 48 of the 50 contiguous states. It's cheaper to generate using renewables than it is to use either natural gas or coal, and that's without subsidy. So we are definitely seeing the doors opening there. In Canada, what we find is it's a very regulated monopolistic environment in most of the Canadian jurisdictions, and so there is definitely, I think, government influence on, and so socioeconomic development is kind of driving the bus in those areas. So we're not as optimistic about developments in Canada for the next little while. Europe, what we're seeing is that the European market was well ahead of North America in the advancement of renewables, but because land is a scarce resource in most of Europe, they tended to be small projects that were built by small developers. And so there's a massive consolidation that is happening of project ownership in order to get synergies on operating costs and maintenance costs and that kind of thing. So that's the big trend we're seeing in Europe, is consolidation.
Very well, very well. We have someone here who's talking about coal-fired power plant investments in Florida, and specifically a large utility in Florida who apparently has got to the conclusion that it's actually cheaper to build renewables today than to not just build but maintain a coal-fired power plant. Curious if that economic situation is peculiar to that state, or it's something that you're seeing more regionally or globally, where the cost of renewables has gotten to a point that not only you may be replacing capacity that was previously coal-fired power plants or combined cycle power plants, but also even replacing capacity because it's cheaper to build renewables than to maintain existing coal-fired power plants. Is that something that works out in other places, or this is just a regional situation?
No, I think that it is taking place in a number of jurisdictions, specifically areas where they're beginning to put a dollar value on carbon emissions. That is definitely one area that would be driving down or driving up the cost of operating a coal plant. But as well, they are significantly higher in terms of their labor cost. It's a labor-intensive business running a coal plant, whereas running a solar plant or a wind farm, relatively little labor cost in terms of ongoing maintenance, and the fuel is free. So you don't have transportation cost, or you don't have the whole logistical exercise in getting the fuel to site. The fuel arrives by dint of Mother Nature, and that's probably the cheapest way to get fuel that you can possibly imagine.
Very good. Another question we have here, and there are a number of questions around this topic, has to do with the impact of the pandemic, not only on the energy market, which certainly in oil and gas has been massive, and the energy market as a whole, but how has that affected your business and the royalties model, pre-pandemic and during the pandemic now?
Yeah, and it really is interesting. To date, none of our clients have been impacted by the pandemic. So the projects continue to generate electrons. The electrons continue to go to the grid, and they can consumed by the grid. Unlike primarily transportation fuels, I think what we're seeing in areas with air conditioning load is that people are staying at home more, they're working from home, they're probably using more electricity at home. Yes, the office buildings are not using as much, but that's almost more of a fixed cost for most of those offices, so they can't really turn them down as easily. So yeah, to date, we have not seen any exposure. And in the areas where there's a retail or a market for electricity, as opposed to it being monopoly controlled, we're not seeing market prices drop the way that we have seen in the oil and gas sector.
Very good, very good. This other question is related to technology and the price performance decreases in technology. Well, increases, the price performance increases in technology, or to say it in a different way, I guess, the decreases in cost. There have been exponential decreases in cost for wind, much more so even for solar and the storage, as you mentioned. Are we getting to the asymptote here? Are we getting to the point where it's starting to level off, or that trend is expected to continue in the next 5 to 10 years?
Yeah, I mean, and that is interesting, because I would have told you 5 or 6 years ago that I thought we were getting to the asymptote on wind costs and the decrease in wind costs and the increase in efficiency. And what we have seen is the manufacturers have gone to the next level of size of wind turbines, and it's blowing the doors off in terms of the efficiency. And I would not have told you that was going to happen 5 years ago, but it is happening still. So I think there's continued room for the economies of scale of size of turbine and the efficiencies to continue. The other thing on the wind side you're seeing is people spending a lot more time with the analytics, looking at how much time in advance they can see the wind direction changing, and can they move the turbine more quickly to embrace that wind direction change. And that's adding 3 or 4% annual production, which can be massive. On the solar side, the big new development is bifacial panels, which means you're not only generating electricity from the photovoltaic coming directly from the sun, but you're picking up on reflection off of the ground, or in northern environments like Canada, you can pick up reflection off the snow, which means the efficiency of a solar panel in what they call a gray environment, as opposed to a sunny environment like where you are in Texas, has actually increased dramatically as well. So I think there's still lots of room on the solar side for efficiency. And as we talked about on storage, the floor is is a long way away yet. I think that curve is going south in a big hurry. So,
how much the electrification of the economy, especially driven by electric vehicles, impacts your own forecasts of the shift?
For us, electric vehicles, and I think from, and there's lots of research out there about what the impacts of electric vehicles will be. For the most part, I don't think people are seeing that it's going to generate a huge increase in demand, but it will change the shape of the demand curve on a 24-hour basis and on a seasonal basis. So again, electricity in the northern hemisphere is predominantly used for heat, and so there's a massive spike in electricity consumption during the winter, and not so much in the summer. Where you are, there's a massive spike in the summer versus winter. So I think that what most people are predicting is that the increased use of electricity for transportation will smooth out that seasonal curve. And then we're not yet sophisticated enough in time of use rates to know how it's going to impact time of day, but I can easily see a scenario where an electric vehicle will not only be a transportation device, but it'll be a movable electricity storage device. So you would be able to plug it in when you get home from work, and then at midnight, once it's fully recharged, you can turn it on and say, okay, I'd like to send back to the, I'd like to generate electricity for the utility and reuse my battery that way, then charge it up again starting at 4 in the morning so that you're ready to go to work. And when you're at work, it can also be used as a storage device. So I think that side of it is going to be a massive business in the whole analytics piece, trying to figure out exactly what that impact is, but nobody's sure yet.
Very good, very good. We have one final question here. This one has a bit of commentary on the observed shift from utilities to renewables, and some utilities were actually moving faster than the regulatory body would request them to do. There's a mention of Duke Energy and some other utilities in the Northeast who are ahead of the plans for the shift into renewables. The question is really, will utilities remain viable, or the distributed energy model will ultimately cannibalize the utilities market, if you will? I don't know. I know you have a deep background in that, in the utilities area. But just, and it's hard to predict what's going to happen there, but just kind of your thoughts on this shift that's going on and what impact it will have on the business model for utilities.
Yeah, I think there's certainly, as we move along the storage, the local distribution side, there will be pressure on the utilities. I mean, the utility death spiral has been predicted for a few years, and I think there is definitely, if I were sitting in a utility shoes, I would be worried about 10 to 20 years out, because I used to work many years ago for one of the gas utilities in Canada, and we used to say that as long as we were more popular than the cable company and we had better customer service rep than the cable company, we were okay. But people really dislike the idea that there's a monopoly that's plugged into their house and that they're reliant on for customer care or for service. And so I think, especially in the US with that view to independence and not wanting to be beholden to anyone, I think there's a huge risk for the utilities. But what you're seeing is the smart utilities are getting out ahead of it. So in the Northeast of the US, what they're doing is they're now saying, the utility is coming to the customer and saying, we'll put the storage in your house and we'll be able to claim, we'll pay for it. You've got a storage battery set up in your house and we'll utilize that when we need to draw on it. And it's a way for them to further, I think, ingratiate themselves into the home. It's kind of like the hot water heater business, right? Some utilities make you buy their hot water heater and someone else will say, well, no, I'm happy with you going buying it at Home Depot. But definitely I think the smarter utilities are trying to figure out how to extend that share of customer wallet in the event that self-generation becomes much more possible.
Very well. To build on your analogy, since so many of the cable companies have gone away, and
Yeah,
now the utility become the main target, so that the reference has gone away, they have to transform themselves, and many of
yeah,
them are. And as a matter of fact, next week we have it's a focus on oil and gas, but there's some energy players will be discussing that on the oil and gas conference live. Peter, thank you so much for sharing the journey of RE royalties with us, and a very interesting business model, service to society, all built into one. And very much grateful for your expertise in sharing that with us today.
thank you, Jose. I really appreciate the opportunity, and thank you all for taking the time to listen today.
Thank you. All right, ladies and gentlemen, this concludes Financial Services Live. I hope that you gain insights from these top leaders across multiple industries related to financial services. We had banks, we had insurance companies, we had renewable energy royalties organizations sharing their journey and their impact on clients and society in general. So next week, we are going to be back here with a great lineup of cross-industry global leaders in the oil and gas industry, and more broadly speaking, in energy organizations. So we're going to have very great insights on how the whole sector is reacting to the effects of COVID-19, and most important, many other trends that have been going on in the world pre-pandemic, like the electrification of society, and the environmental challenges that we have, and how do we plan and execute strategies going forward in the energy space. The energy industry is a multi-trillion-dollar industry, and we're gonna have some of its biggest players talking to you directly here next week at Oil and Gas Live conference. For those of you who participated throughout the sessions, thank you very much for your engagement. The questions are outstanding. Your engagement is awesome. I see real practitioners and leaders on the field who are asking these questions, very pertinent questions to our speakers, and that enriches everybody's experience. And on that note, you can continue to engage and discuss, leave commentary on our posts on LinkedIn. So search under our names on LinkedIn, and you'll see the post for Financial Services Live. And put your comments in there. Several of our speakers circle back to those pages and provide answers, and certainly we will provide you with our gratitude for being part of the show. So thank you very much. Have a great rest of your day. Have a wonderful weekend, and hope to see you back on Tuesday for Oil and Gas Live. Thank you, everyone.